Affirm looks harmless because the payment is small, but your lender may not see it that way. One buy now, pay later payment can look very different when it sits next to your credit report, bank statements, cash flow, and debt to income. So before you tap pay, we are going to stress test what that small payment can really do. Let's start at checkout. Now let's talk about the lender side. This doesn't mean every lender treats every buy now, pay later payment the same way. Lending practices vary, underwriting guidelines change, and one small payment is not automatically a problem. That's not the point. The point is that when a lender reviews your application, they're not looking at just one number. They may look at your credit report, your bank statements, your monthly obligations, your debt-to-income ratio, and whether your recent financial behavior looks stable, stretched, or risky. Some buy now, pay later plans may show up on your credit report, depending on the lender and the type of plan. Others may not appear on a credit report directly, but can still be visible through bank statement activity, cash flow patterns, or what you disclose on the application. The reporting landscape for buy now, pay later is still evolving. Some major credit bureaus have started adding BNPL data to credit files. How your plan is reported may depend on which service you used and when. So the safer assumption before a major financial move is this: don't count on your buy now, pay later payments being invisible to a lender. They may show up in ways you didn't expect. And if there are multiple payment plans in your history, the question a lender may ask isn't just whether each payment was made. The question may become, how much of this person's monthly income is already spoken for? Let's make the math simple. One buy now, pay later payment might look like this: $42 a month. That doesn't feel like a financial emergency. But now let's stack a few of them. Payment 1, $42 a month. Payment 2, $67. Payment 3, $38. Payment 4, $91. By themselves, each one looks manageable. But together, that's $238 a month. That's no longer a harmless checkout option. That's a monthly obligation. And $238 a month can matter. It can matter when a lender reviews your debt-to-income ratio, when you're trying to qualify for a mortgage, when you're buying a car, when an underwriter is looking at how much monthly cash is already committed. Debt-to-income compares your monthly debt obligations to your monthly income. Lenders use it to decide how much additional debt you can carry. When buy now, pay later payments are counted as part of that picture, even small ones can affect the number. The danger is not the size of one payment. The danger is what happens when several small payments get added together. Even if preparing for a mortgage, auto loan, refinance, or any major financing decision, here's what to do before you apply. First, check all of your buy now, pay later balances. Add them up. Know the total, not just the monthly payment, the actual outstanding balance on each plan. Second, pay off open balances if you can before applying. A closed balance is better than an open one when a lender reviews your file. Third, don't open any new buy now, pay later plans in the months before you apply. Even a small new plan can show up as recent borrowing activity, and some lenders pay attention to that. Fourth, give reporting cycles time to update. If you've paid something off, check that it's updated across your credit reports. That can take 30 to 60 days. Fifth, pull all 3 credit reports: Equifax, Experian, TransUnion. You can get free copies at annualcreditreport.com. Look for any buy now, pay later accounts that are reporting, and check whether they show as current, paid, or open. Sixth, ask your loan officer directly. Tell them you've used buy now, pay later. Ask how those obligations are counted in your review. It's better to surface it yourself than to have it come up during underwriting. The goal is to walk into a major loan application with a financial picture that's clean, accurate, and easy to explain. So what's the verdict on buy now, pay later? Here's how I'd stress test it. Pass. Your situation may pass if you have no open balances, or one small balance that's nearly paid off. No major loan application coming up. Every payment fits clearly inside your monthly budget, and you know exactly when each plan will be paid off. Caution. It moves into caution if you have 1 or 2 small open balances and no urgent loan application, but the balances should be cleaned up before you apply for anything major. You're not in trouble today, but you need to know the picture before your situation changes. Fail. It fails the stress test if you're carrying multiple open balances. Payments are stacking every month. You're preparing to apply for a mortgage, auto loan, refinance, or major credit. Or you haven't fully accounted for what these obligations look like together. The simple rule is this: if the payment only works because it feels small, slow down. Check the full cost, the monthly stack, and how it fits your financial picture before a lender does it for you. Affirm and buy now, pay later are not automatically bad, but they're not automatically invisible either. They pass the stress test when the payment is planned, fits your budget, and you're not heading into a major financial review. They move into caution when payments start stacking, or a big loan decision is coming. And they fail when the stack of small payments makes your financial picture harder to explain. Before you add another payment, pressure test the decision. Use the money stress test framework before you tap pay. More money stress tests are on the way. Subscribe so you don't miss them.